Hello, my name is Arvin Taali. I am the owner and operator of Elixir Mortgage Lending here in Aliso Viejo, California. We lend on home loans in California and Florida for primary residence, along with everything else, the investment properties and all sorts of stuff. And we lend on non-owner occupied nationwide. I wanted to go over a little bit of what we do and how we are different and unique. As far as I've been in business since 2018 operating, and I have been doing home loans since 2013. And what I have learned over these years is I pretty much underwrite my files, which in this case, when I speak to a client, I am already underwriting where the loan can go, how we are able to execute it and get it done. So when we're speaking, I am making sure that I'm putting you in the best possible outcome. And with that stated, we offer conventional financing, which rates have improved drastically in recent history. And the Fed did lower the rate. And aside from lowering the rate, our rates tend to be below where the market is, because as far as our investors go, they're taking on a little less margin, which means the pricing is actually better at par than where the market is currently. And that goes for FHA loans as well as VA loans, reverse mortgage. And these type of loans, I'm gonna exclude reverse for a moment there. These type of loans, conventional FHA or VA, they have the best terms. They also require income and more documentation. As far as for those who can qualify with income, documentation, higher credit scores, these loans are wonderful. And for those who are self-employed or maybe have credit blemishes or less documentation available for us to do loans, there is another category. And the next category is going to be, rather than conventional, I'm going to categorize it as soft money. And soft money, what we're going to say here is going to be clients, maybe they don't show enough income on their taxes, but they have steady cash flow. So we could show maybe 12, 24 months cash flow if we need to look back. Or, they're recently in business, perhaps maybe a year in business, but they had a really good year. We can look at the cash flow and make that work. There is a lot of options also without even cash flow at all. And that would mean it falls into the stated category. These loans are going to be higher interest rate than where the market is. Generally, a ballpark, just figure idea, about 2% above where the market is. But you can qualify with less documentation, no documentation, or just bank statements. Some cases, I may collect one bank statement or two, for reserves, but may not even need income. And for those who are doing cash out refinances, a lot of times on stated, we don't need reserve requirements. And the difference between conventional now, if you're going out and buying a home, versus some of these soft money loans is different. On conventional, you can, if you're a first-time home buyer or haven't owned a home in 3 years, you can get in with 3% down. With FHA, you can get in with 3.5% down. With VA, you can go up to 100% financing. If you do already own a home or have owned a home and now you're buying a new primary residence, these are primary residents, by the way, we can do with 5% down. Now with soft money, now I'm jumping the other way, with stated, you're gonna probably need 20 to 25% down in most cases if you're buying a primary. With the bank statement loan stuff, you're gonna need at least 10 or 15%. The difference also is with conventional, if you put, let's say 5% or 3%, you're gonna have mortgage insurance in most cases. Not all cases, but most cases. With the 10, 15% down or the 20% down, at least you don't have mortgage insurance. The rates are higher, but there are some differences, and I'm trying to draw the contrast to these. And you can get 30-year fixed loans on all of these loans, and you can get 15-year fixed loans. You can do adjustables if you wish to. With conventional, you could do a buy down where you can get the rate, 3-2-1 buy down. As far as with the soft money, you can pay points and lower your rate, but generally we don't have that buy down option in that same format. And there is lender credit when it comes to conventional loans, but there's less categories for lender credit in the soft money space. So now we've covered primary residence in the conventional format, FHA and VA in these categories, and for self-employed options which require cash flow rather than taxes and what's left over. Now I'm going to jump into the next category, which is mostly investment property. Investment property, you can still do 30-year fixes, and the options are you can do a bridge loan. Anytime something like a term bridge comes in, or if somebody even uses the term like hard money or private lending, a lot of times what that means are 1 to 3 year terms. And hard money right now with better credit scores, they're much faster to do in case you need to get an acquisition done quickly, or documentation is lacking, or you don't qualify with income. And with investment properties, you should anticipate 20 to 25% down. These loans are going to now be higher than the soft money category, which we said it's probably going to be at least maybe about 2% above where market is. These are probably going to be another % to 1.5% higher. So now you're talking about in the category of about 3.5% higher than where the market is going to be. But there are advantages. For example, if you're buying a property to fix it and maybe either sell it or fix it and then rent it out, you can do different steps. Step 1, you do the acquisition, or if you already own it, you can also do refinance to take money out. But in the acquisition point, I am jumping around all over here. What you can do is also finance the rehab. And what we need to know is how much money you need for rehab and what the after repair value is. So I'm going to use an example. Let's say the property is worth $100,000 and you need $50,000 rehab. And with that $50,000 rehab, the property will be worth $200,000. For simplicity of numbers, I'm using these smaller dollar figures. And so if we say the property is $200,000, these are the things we're looking for. If the borrower has experience, wonderful, we can do better. And if the borrower doesn't have experience, you still can do the loan. Better case scenario is on $200,000 after repair value, we can probably go, most cases, about 70% with a little experience. And 70% of after repair value, or ARV, means we can finance $140,000. Now, if you remember the example I used, $100,000 is the purchase price, $50,000 is the rehab money needed, and then if the after repair value is $200,000, you can do $140,000 of financing in most cases. Now, the parts that are not being mentioned, which this is the fine print that I want to bring out, is most investors are going to want to see you have at least 10 to 15% skin in the game. So let's say the $100,000, 10% skin in the game, $10,000. Well, you land right at that 140 and you got $140,000 of financing coming in. So the math will keep the money in your bank account more because of the way the financing works, and you end up with more financing, and you have the option, if you're going to keep it afterwards, for us to do some type of debt service coverage ratio, which means we're evaluating whether the property is going to, what it's going to rent for, and we can qualify you based on rental assessment. And the main thing we're looking for is this. Let's say the mortgage is going to be $2,000 a month. We want to make sure that the rent you can collect on that property is going to cover that. In most cases, it's about 1:1 to 1.1, which means you're going to want to collect $2,000 to $2,200. That's going to be for the principal, interest, taxes, insurance, to cover the payments. And if in case you're going to sell the property, you can pay the loan back on that fix and flip that I was covering right before this debt service ratio, and pay the loan back, and hopefully walk away with the profit of whatever the difference of that $50,000 is. So there are a lot of opportunities using financing to get ahead. I just saw a headline recently that said for house flipping, there is still on average a margin of about $60,000 to $65,000 to be made on the average flip. So there is still some room compared to previous years. It is tighter, but there is still room to find projects and make a little bit on it. Now, I'm going to now jump in to the category of debt service if in case that doesn't work. So if you do debt service coverage ratio, and let's say right now you have an existing property and the mortgage on it is $4,000 and you could only rent it out for $2,000. Well, you're upside down $2,000 a month. And let's say your loan comes due right now and you don't want to sell the property, or it's not an opportune time to sell it, and you still need to get into a loan, you can. And you can do it without a service ratio, which means now we're looking at it as an asset-based property. You can still do a 30-year loan. So this is not a hard money loan in that format, which is short term, but the rates are going to be in the near hard money category. They're higher than soft money, but yet they're on the low side of hard money. And generally these have prepayment penalty, and so does debt service coverage ratio. The benefit to this is if you're gonna park that for about 3 to 5 years minimum, sometimes it can make sense. There are options to buy down the prepayment penalty down to 1 year. You do generally pay about 1 to 1.25 points to do that, but there is an option. But you don't want to ever buy it down and try to sell it in the first year, or have to sell it in the first year, because then you pay too much fees. It's not worth it. Now, the next category, if now we've exhausted DSCR, debt service coverage ratio for investors, and bridge loan, and none of these are coming together for different reasons. Every property is also different. Maybe it's run down, or the location is not desirable, or is bordering on like a rural town or area, which lending is harder. Whatever the circumstance, or a credit that's harmed, or there's late payments, too many showing up on the credit report where it's taking us out of doing it a little bit more clean. Then there's the hard money option. The hard money option is the higher rates. They are a little bit more expensive to close in most cases, in some cases a lot more expensive. But they will at least get you financing. They will require a lot more equity than these figures that I named off earlier of 20 or 25% down. Now we're talking about probably equity of 50 to 60% loan to value. So you're gonna have to have massive equity or a massive down to get in that category. But that category, depending on the situation, some cases, someone might say it's not the right time. I don't want to sell the property and I still want to hang on to it and I'm willing to pay for the financing. Other times, maybe there's an upside, but they're waiting on permits or something and a loan matured. Then we have to look at an option like that, which is certainly less attractive, but there are reasons that that loan still exists. And the reason generally is the client wants to keep the property or wants to make the acquisition despite of it. Now, in that category, in the state of California, there is also an option for primary residence with same type of equity position. It has to be really strong. Credit can be hurt. It could even be near foreclosure in some cases, but most cases, if it's gone on too long or it's on the brink of being foreclosed on, unfortunately, then that option starts kind of fading away. But there are options to keep financing on the property. The best options are always going to be the conventional, and that is the most attractive one. Most of the time when I have someone call me and ask for rates, they're trying to get the best rates. They're going to be in the conventional category, but the reality or the truth of the time is rates are higher. The financing that's being done is higher. The prices of the homes are higher, and people, they're making maybe a little bit more money as far as income, but we're seeing more debt on their credits because that is also going to offset some of the income. So these are the challenges of the current time in 2025, but there are options still within the time. Not all of them is the ideal situation for anyone. Everyone, I should say, not anyone. And some cases, it's not good for some people to do some of these loans. And what we do is make an assessment, and from that assessment, we would come back with options, underwrite it, and if it makes sense, wonderful. And some cases, you know, if it's an emotional decision, then it's up to you to want to keep the property or whether you want to finance it. That also happens sometimes or a lot of times. So when somebody's holding a property, it's not because of financial reasons. It may have an emotional attachment to it. And I would be the one to be telling you, you know, there's financing of this sort available, but, you know, if you're not attached to it, perhaps maybe even selling might be an option. We don't sugarcoat it. We do say it. Not everybody necessarily loves or wants to hear that. I'm sure I wouldn't if I love my place or my home to hear that, but the truth or reality does exist, and we're here to help and serve you. So we're not here to just do loans. Loans, wonderful. That's how I earn my income. But if there's an upside and a downside, and the downside is too far, you are hiring me as your mortgage broker to protect you. And it's my job to make sure that I'm voicing that. As far as home loans go, we can lend in up to about 40 states on investment property. And there are some states that is harder to do loans in. And in California and Florida, up and down the coast, pretty much we can do loans. It doesn't matter anywhere in those 2 states. And if you have any questions, feel free to reach out, and thank you.